If you've been holding silver in your retirement account, what I'm about to share with you might be the most important information you hear all year. Because right now, at this very moment, something extraordinary is happening in the silver market that most retirees have absolutely no idea about. And the window to act on this information is closing faster than you might think. Let me ask you something. Have you noticed how quiet the mainstream financial media has been about silver lately? Almost suspiciously quiet. While everyone's been distracted by stock market volatility and the latest economic headlines, silver has been staging one of the most remarkable rallies in recent memory. And here's what's really interesting. The institutions, the central banks, the people who move billions of dollars with a single decision, they've been accumulating silver at a pace we haven't seen in decades. They know something. And today, I'm going to show you exactly what that is. Right now, silver is trading at levels that have broken through resistance points that held for years. We're seeing technical patterns that historically have preceded massive price movements. But this isn't just about charts and lines on a graph. This is about fundamental shifts in the global economy that are creating what some analysts are calling a perfect storm for silver prices. And if you're a retiree with any exposure to precious metals, or if you've been thinking about protecting your wealth from what's coming, you need to understand what's happening right now. Think about this for a moment. Silver isn't just a precious metal anymore. It's become absolutely critical to the technologies that are reshaping our world. Every solar panel requires silver. Every electric vehicle uses significantly more silver than traditional cars. The green energy transition that governments around the world are pushing, that's creating industrial demand for silver that's unlike anything we've seen before. And here's the kicker. We're not producing enough silver to meet this demand, not even close. The supply situation is actually far more dire than most people realize. Major silver mines around the world are facing declining ore grades. That means they're having to dig deeper and process more rock to get the same amount of silver. Production costs are rising. And several major producing countries are dealing with political instability, labor disputes, and environmental regulations that are constraining output. Meanwhile, demand is accelerating. It's not just industrial demand either. Investment demand has been surging as more and more people wake up to what's happening in the broader economy. Let me paint you a picture of what's really going on behind the scenes. Central banks have been net buyers of gold for years now. Everyone knows that. But what's less talked about is how silver is increasingly being viewed as gold's undervalued cousin. The gold-to-silver ratio, which historically averaged around 60-1, has been all over the map in recent years. When that ratio gets stretched, when silver becomes too cheap relative to gold, smart money starts flowing into silver, and we're seeing that flow accelerate right now. But here's where it gets really interesting. The paper silver market, the futures and derivatives that trade on exchanges like the COMEX, that market is enormous compared to the actual physical silver that exists. We're talking about claims on silver that far exceed the actual metal available for delivery. It's a system that works fine as long as everyone's content to trade paper contracts. But what happens when people start demanding physical delivery? What happens when the industrial users who actually need silver for manufacturing start competing with investors who want to hold the real metal? Before I go any further, I want to share something with you. I've put together a comprehensive guide that breaks down the strategies thousands of American retirees are using right now to protect their hard-earned wealth. It covers everything from understanding precious metals markets to specific steps you can take to safeguard your retirement savings. You'll find that guide in the description below. It's completely free, and if you're concerned about protecting what you've spent a lifetime building, I'd encourage you to grab it while it's still available. Now, let's talk about what's happening in the physical silver market, because this is where things get absolutely fascinating. Premiums on physical silver, the amount you pay above the spot price to actually get your hands on coins or bars, those premiums have been elevated for months. Dealers are reporting supply constraints. Mints around the world are struggling to keep up with demand. The United States Mint, the Royal Canadian Mint, the Perth Mint in Australia, they're all dealing with the same issue. People want physical silver, and there's not enough to go around at current prices. Think about what that means. When you have a market where the paper price says one thing, but you can't actually buy the physical metal at that price, you have a disconnect. And historically, when these disconnects happen in commodity markets, They resolve themselves in dramatic fashion. The paper price eventually has to catch up to the physical reality, and when it does, the moves can be explosive. Let me take you back to a similar situation that played out in another market. In the late 2000s, there was a squeeze in the rhodium market. Rhodium is a precious metal used in catalytic converters. Supply was tight, demand was strong, and the price went from around $2,000 an ounce to over $10,000 in a matter of months. Now, I'm not saying silver is going to quintuple overnight, but I am saying that when supply and demand fundamentals get this out of whack, prices can move much faster and further than most people expect. And here's something that should concern every retiree who's watching their purchasing power erode. The monetary system we've all grown up with. The system where the dollar is the world's reserve currency and central banks can print unlimited amounts of money without consequences. That system is showing serious cracks. Countries around the world are increasingly settling trade in currencies other than the dollar. The BRICS nations, that's Brazil, Russia, India, China, and South Africa, they're actively working on alternatives to dollar-based trade. And when confidence in fiat currency starts to waver, people historically have turned to precious metals. Silver has been money for thousands of years. Long before paper currencies existed, silver coins were used for trade across civilizations. There's something deeply embedded in human psychology about the value of silver and gold. You can't print more of it. You can't create it out of thin air with a computer keystroke. It has to be mined from the earth, refined and minted. That scarcity, that tangibility, that's what gives it value when paper currencies are being debased. Now, I want to talk about something that most financial advisors won't tell you, because frankly, many of them don't fully understand it themselves. The relationship between silver prices and real interest rates. When you adjust interest rates for inflation, when you look at what you're actually earning after accounting for the rising cost of living, real rates have been negative for extended periods, and historically, negative real rates have been incredibly bullish for precious metals. Why? Because when you're losing purchasing power by holding cash or bonds, hard assets become more attractive. The Federal Reserve and other central banks have been trying to manage this delicate balance. They want to keep interest rates high enough to control inflation, but not so high that they crash the economy. It's a tightrope walk. And every time they've tried to maintain this balance in the past, they've eventually had to choose. Either they let inflation run hot, which destroys the value of the currency, or they raise rates high enough to cause a recession, which forces them to cut rates and print more money to stimulate the economy. Either scenario is bullish for precious metals. Let me share a story that illustrates what's at stake here. Back in the 1970s, we had a similar situation. Inflation was running rampant. The dollar had been disconnected from gold. People were losing faith in the currency. And silver went from around $2 an ounce to $50 an ounce in a matter of years. Now that was an extreme situation, driven by unique factors, including the Hunt brothers trying to corner the market. But the underlying dynamic was the same. When people lose confidence in paper money, they seek alternatives. Today, we have even more reasons for concern. Government debt levels are at historic highs. The United States alone has debt exceeding $30 trillion. That's trillion with a T. And the interest payments on that debt are becoming one of the largest line items in the federal budget. How do governments typically deal with unsustainable debt levels? They inflate their way out of it. They print more money, which makes the debt easier to pay back in nominal terms, but destroys the purchasing power of everyone holding that currency. For retirees, this is especially dangerous. You've spent decades saving, building up a nest egg that's supposed to support you through your retirement years. But if inflation runs at 6, 7, 8% or higher, your purchasing power gets cut in half every decade. The money you thought would last 20 years might only maintain your lifestyle for 10. That's not a theoretical risk. That's a mathematical certainty if inflation remains elevated. And here's where silver becomes particularly interesting for retirement planning. Unlike stocks, which can go to zero if a company fails, or bonds, which lose value when interest rates rise or when the issuer defaults, physical silver has intrinsic value. It's used in industry. It's recognized as money. It can't be inflated away by a central bank's printing press. It's a form of insurance against the monetary chaos that seems increasingly likely. Now, if you're sitting on $100,000 or more in retirement accounts, I want to share something important with you. There's a strategy that many retirees don't know about called a gold IRA. It allows you to hold physical precious metals, including silver, inside a tax-advantaged retirement account. You get the same tax benefits as a traditional IRA, but instead of holding paper assets that are vulnerable to market crashes and currency debasement, you're holding real, tangible metal. I've put together a detailed guide on how this works, the rules you need to follow, and how to set it up properly. You'll find that in the description below. It's worth looking into if protecting your retirement savings from what's coming is a priority for you. Let me get back to what's happening in the silver market right now, because the technical picture is absolutely fascinating. We've broken through resistance levels that held for years. The moving averages are aligning in a way that technical traders call a golden cross. Volume has been increasing on up days and decreasing on down days, which suggests strong buying pressure. And the commitment of traders report, which shows the positioning of different market participants, is showing that commercial traders, the ones who typically have the best information, have been reducing their short positions. What does all that mean in plain English? It means the smart money is positioning for higher prices. They're not fighting the trend anymore. They're going with it. And when you see that kind of shift in positioning, it often precedes significant price moves. But let's talk about the elephant in the room, the question everyone wants answered. How high can silver go? And more importantly, how fast can it get there? I'm not going to give you a specific price target because anyone who tells you they know exactly where silver will be in 6 months or a year is either lying or delusional. Markets don't work that way. But I can tell you what the fundamentals suggest. If silver simply returned to its historical ratio with gold, we'd be looking at significantly higher prices from current levels. If industrial demand continues to grow at the pace it's been growing, and supply remains constrained, basic economics tells us prices have to rise. And if we see any kind of monetary crisis, any loss of confidence in major currencies, silver could move much higher, much faster than most people think possible. Here's what concerns me, though, and this is something every retiree needs to understand. The moves in precious metals markets don't happen in a straight line. There will be volatility. There will be pullbacks. There will be moments when it feels like the rally is over and you should sell. But historically, the biggest gains in precious metals have come to those who held through the volatility, those who understood the long-term fundamentals and didn't get shaken out by short-term price swings. Let me tell you about what happened during the last major silver bull market. From 2008 to 2011, silver went from around $9 an ounce to nearly $50, but along the way, there were multiple corrections of 20, 30, even 40%. People who sold during those corrections missed the biggest gains. People who understood why they owned silver in the first place, who saw it as insurance against monetary instability rather than just a trading vehicle, those people held on and were rewarded. The situation we're in today has some eerie parallels to that period. We have massive monetary stimulus. We have concerns about the stability of the financial system. We have geopolitical tensions that are driving countries to diversify away from dollar-based assets. And we have supply constraints in the physical silver market that are becoming increasingly apparent. But there's also something different this time. The industrial demand story is much stronger now than it was back then. The green energy transition wasn't really a thing in 2008. Electric vehicles were a novelty. Solar power was expensive and inefficient. Today, these technologies are mainstream and growing rapidly, and they all require silver. Lots of it. Think about the scale of what's being planned. Governments around the world have committed to net zero carbon emissions by mid-century. That means a massive build-out of renewable energy infrastructure. Solar panels, wind turbines, electric vehicles, battery storage systems. All of these technologies use silver. And the amount of silver required to meet these goals is staggering. Some estimates suggest we'll need more silver in the next 20 years than has been mined in all of human history. Now, you might be thinking, well, if demand is that high, won't mining companies just produce more silver? And that's a logical question. But here's the problem. Most silver isn't mined as a primary product. It's a byproduct of mining other metals, like copper, lead, and zinc. So silver production is largely dependent on the economics of those other metals. You can't just decide to mine more silver. You have to mine more of the primary metals, and silver comes along as a bonus. And even if mining companies wanted to ramp up production, it takes years to bring new mines online. You have to find the deposit, which is getting harder as the easy-to-find deposits have already been discovered. You have to get permits, which in many countries is becoming increasingly difficult due to environmental regulations. You have to build the infrastructure, hire the workers, and start production. By the time a new mine comes online, the market conditions that justified building it may have changed. This is why supply constraints in commodity markets can persist for years. It's not like manufacturing, where you can build a new factory in months and start cranking out products. Mining is a long-cycle business. And right now, we're in a situation where demand is accelerating faster than supply can respond. Let me share another historical parallel that I think is relevant here. In the 1930s, during the Great Depression, gold was revalued from about $20 an ounce to $35 an ounce. That was a 50% increase mandated by the government. Why did they do that? Because the existing price of gold wasn't high enough to support the amount of currency they needed to print to get the economy moving again. They needed to devalue the dollar relative to gold to create monetary flexibility. Could something similar happen today? Could we see a scenario where governments faced with unsustainable debt levels and the need to stimulate their economies effectively devalue their currencies relative to precious metals? It's not as far-fetched as it might sound. In fact, some analysts argue it's inevitable. The math simply doesn't work otherwise, and if that happens, if we see any kind of official recognition that currencies need to be devalued relative to hard assets, the repricing of silver could be dramatic. We're not talking about a gradual increase over years. We're talking about the kind of move that happens in months or even weeks, the kind of move that catches most people completely off guard. This is why positioning matters. This is why understanding what's happening before it becomes obvious to everyone else gives you an enormous advantage. By the time silver is making headlines on mainstream financial news, by the time your neighbor is talking about it at the grocery store, most of the move will already be over. The time to position yourself is when the fundamentals are aligning, but the crowd hasn't caught on yet. And that's exactly where we are right now. The fundamentals are screaming that silver is undervalued. The supply and demand dynamics are incredibly bullish. The monetary backdrop is supportive. The technical picture is confirming the fundamental story. But most people aren't paying attention. They're worried about their stock portfolios, or they're trying to time the housing market, or they're just hoping their retirement savings will somehow be enough. But here's what I want you to understand. Hope is not a strategy. Hoping that inflation will come down, hoping that your portfolio will recover, hoping that the government will figure out how to manage its debt without destroying the currency, that's not a plan. That's wishful thinking. And in the environment we're heading into, wishful thinking could cost you dearly. The retirees who are going to thrive in the coming years are the ones who are taking action now. They're the ones who are diversifying out of purely paper assets. They're the ones who are holding real, tangible wealth that can't be printed or debased. They're the ones who understand that the rules of the game are changing, and they're positioning themselves accordingly. Let me tell you what I'm seeing from the retirees I work with who get this. They're not putting all their eggs in one basket. They're not selling everything and going all in on silver, but they are making sure that a meaningful portion of their wealth is in hard assets. They're treating precious metals as insurance. And just like you wouldn't cancel your homeowner's insurance because your house hasn't burned down yet, you don't sell your precious metals insurance just because the monetary crisis hasn't fully materialized yet. The beauty of silver as a retirement asset is that it serves multiple purposes. It's a hedge against inflation. It's a hedge against currency debasement. It's a hedge against financial system instability. And unlike many hedges, which cost you money to maintain, silver has the potential to appreciate significantly if any of these risks materialize. It's asymmetric. Your downside is limited to the current price, but your upside is potentially enormous. Now, I want to address something that I hear a lot from retirees who are skeptical about precious metals. They say, well, silver doesn't pay a dividend, it doesn't generate income. Why would I hold something that just sits there? And that's a fair question. But here's what I'd ask in return. What good is a dividend if the currency it's paid in is losing value faster than the dividend yield? What good is income if your purchasing power is being destroyed by inflation? The purpose of holding silver isn't to generate income. It's to preserve wealth. It's to make sure that the purchasing power you have today is still there tomorrow, next year, and 10 years from now. And in an environment where currencies are being debased and financial assets are vulnerable to crashes, preservation of wealth becomes the primary objective. Growth is nice, but not if it comes with the risk of catastrophic loss. Think about it this way. If you have $1 million in retirement savings and inflation runs at 7% for 10 years, your purchasing power is cut in half. You effectively have $500,000 in today's terms. But if you hold assets that appreciate with or faster than inflation, you maintain your purchasing power. You can still afford the same lifestyle. You haven't lost a decade of purchasing power to monetary debasement. This is the conversation that more retirees need to be having with themselves. Not how can I squeeze out another % of yield, but how can I make sure my wealth is still here when I need it? How can I protect what I've spent a lifetime building from the forces that are actively working to erode it? And silver, along with other precious metals, is one of the few assets that has proven itself over thousands of years as a store of value. Empires have risen and fallen, currencies have come and gone, but silver has maintained its value. It's been money. It's been a store of wealth. It's been a medium of exchange across cultures and centuries. That's not an accident. That's because it has intrinsic properties that make it valuable regardless of what any government or central bank does. As we wrap up here, I want to leave you with a few key takeaways. First, the silver market is at a critical juncture. The fundamentals are incredibly bullish. Supply is constrained, demand is accelerating, the monetary backdrop is supportive, and the technical picture is confirming the fundamental story. Second, the window to position yourself before this becomes obvious to everyone else is closing. Once silver starts making major moves, once it breaks through key psychological levels, the crowd will rush in and prices will move much faster. Third, this isn't about speculation or trying to get rich quick. This is about protecting your wealth from very real risks that are building in the financial system. For those of you who've watched this far, I want to offer you something special. That free guide I mentioned earlier, the one that covers the strategies thousands of American retirees are using to protect their wealth. If you grab that from the description below and you're an American retiree with at least $100,000 in any retirement account, you'll also get access to an exclusive one-on-one educational web conference. No obligation, no pressure, just a chance to have your specific questions answered by someone who understands these markets. It's only available to those who mention they watched this video, so make sure you do that when you reach out. The bottom line is this: your time has come, not because I'm saying it, but because the market is saying it. The fundamentals are saying it. The institutions that move billions of dollars are saying it with their actions. The question is, are you going to act on this information, or are you going to look back a year from now and wish you had? The choice is yours, but the window is closing. Don't let this opportunity pass you by.